All right, guys, what's going on? This is Paul Singh, the market speculator with bullsonwallstreet.com. Today, we're going to talk about a recent trade we made and essentially what we did exploiting fear in the market. Now, this doesn't happen a lot. It probably happens on any given year, 2 or 3 times, maybe sometimes 4 or 5 times in a year. But usually you get 2 or 3 really good opportunities. And if you cash in on them, they will end up being some of your biggest trades of the year and most profitable periods of the year when most people are losing their shirts. So, what you want to do here is basically counter trend against what the rest of the market is doing. I will pull our recent TQQQ trade up here. TQQQ is the leveraged ETF for the NASDAQ or the Qs. I'm sure most of you know the Qs ETF here. Now, you could directly trade the Qs, but we don't because we want the extra leverage. Essentially, we want to be able to make more money. You can see here the percentage gain has been, if you took this trade on the Qs and we entered off this hammer, it's been about 10 points on a $150 stock, so less than 10%. Whereas if we look at the TQQ, that same trade, which is 3 times leveraged, has moved from 135 to 162. So essentially almost, I'm not doing the numbers here probably right, but 25 to 30%. So you're going to get more volatility. You can potentially make bigger gains, obviously, with the extra leverage. So that's what we use. Now, what are we talking about when we talk about fear? Anytime the market has been on a big run, you start to get irrationality in the market. And that's what we were seeing here. So you can see here since 2017, actually since November 2016, the market has been on a tear. So basically since the election, we had this low of on TQQQ, look at this, 41. And we had run up to 180. So huge run in the market, even looks more outsized when we look at a leveraged ETF. But look what happened after that. We consolidated for a little while, and then things got really extreme. So we've had this huge run from about 130 to 172 when the market was already extended. So we know at some point, while every pullback had been bought up, so every time there was a little scare, we were getting bought up, we knew at some point there had to be a big dip. And that came in January. And there were signals for this. So I won't get into that too much because our focus here is playing the dip. But we were actually lightening up and actually took some shorts before this dip happened because we were seeing some market breadth indicators. For instance, we were seeing less new highs even though the market was at new highs. Our T2108 indicator, which measures stocks above their 40-day moving averages, was lagging. And that caused us to actually take some shorts here. And we profited even before the dip even happened. But getting to the dip, we had this initial run. Looked like the market might bounce here. I actually took one position here, or 2 positions. It got stopped out. That's fine. And then we got the big dip heading to the 200-day moving average. So a lot of fear. Look at the big volume that came in here. It ended up being green, but a lot, throughout the day, it was a lot of red volume in here. And we had this big dip in here as well. So a move from 184 down to 122, a lot of fear in the market. This is when the weak hands, when the last of those through this run here started to get out. And that's where we get really interested, where everyone else is getting scared and we've been patient. This is where we're ready to pounce. And we did that. Once we got this hammer on Friday, we decided to jump in. And it's a really tough trade. I've done a lot of articles where we talk about, overcoming this fear of trading market pullbacks because it's hard. You're going counter trend. There's this fear that the market's going to continue. If you watch Twitter, if you watch CNBC, you're hearing all this stuff horrible about the market. But then we get the signal. And you have to ignore all that and just jump in on the signal. And that's what we did. If you look at our trade notifications here, 200 shares TQQ. I mistyped the price here. This was 135.77, not 155.77. And then we exited yesterday at 160. So we were looking here 135 to 160 at about a 25 point move on 200 shares. So about 5,000 dollars. So really good trade here. Exited as the market remounted. Now we're on the 5th green day in a row. I do think we're eventually going to test the high here, but we're so extended that I had to lock in that profit. Now, going forward, so we've talked about exploiting this move here and what we're looking for. We're basically looking for extreme extension to the downside, get that reversal signal, ignore what the market is telling you, just go by the signal and enter, manage your risk. And we get out when the market starts to get extended the other way now. And I don't have stochastics here, but we're at 88 on the stochastic level. You know, if it does run, that's okay. This was still a huge win. But now at this point, what are we looking to do? Basically, if the market pulls back here, holds this level, and then shows that it's not going to fail, I would love to re-enter here and test the high. We've got a list of about 15 to 20 stocks we're watching very closely. I just put out the morning report that we're looking for kind of value plays now on pullbacks. Before we were looking for strength. Now we're looking for pullbacks to potentially enter going into tests of the highs and hopefully a total disregard for this down move and we get back on trend. So that's the plan going forward. So this is how we exploit fear in the market. And now that we've done that, be ready for the continuation move. Either we continue back to the upside and we start trading like we always have, or if there is another market failure, we can establish some shorts. So no bias. We're just going to do what the market tells us to. All right, guys. So that's the lesson for today. Remember, you can join the Swing Trade Report where you get the trade alerts. You get a daily video and market analysis, which was just sent out. And if not, the weekly report, which is free, sign up for that and you'll get that on Monday or Tuesday.